Thanks everybody for coming in. Good to see, I think, all of you again. I think we've met most last time. We're here to run through the results of our fiscal year for the ending March 31st, 2018. We'll start kind of with a high-level summary. So how did we do last year? Again, it was, as I've said in the press release, it was a bit of a challenging year, but what I hope to focus on here is where are the positives that happened in the year, and why does that make me feel, the management team feel, and the board feel confident about what the future looks like. There are a lot of underlying positives that we do want to talk about, but we do want to address the challenges that we had and what we're doing about it. So we posted £3.8 million for the year. That's revenue and other income, as we consistently report. That was about a 6% decline on last year. A couple of high points that we'll talk about more is the onboarding of 16 new clients. That's up from 9 last year, new clients, up from 3 the year before that. So we're seeing a nice accelerating progression of onboarding new customers. Importantly, our development revenue increased almost threefold, or over threefold. And we'll talk about why that's important. But that's the revenue that we receive and the business that we receive for developing projects and programs, products for other customers. And that really speaks for the health of the future of what we're doing and for diversification. We'll talk about that. I think the last time I was in this room, we talked a lot about the 8-year results of CondraMedic, which were absolutely fantastic results. Couldn't hope for better results, both from a clinical function point of view, as well as what the quality of the cartilage actually looked like. Since then, since we've rolled out that data, a lot of very affirming and positive feedback from the customer community of the results of those data. Finally, just before Christmas, we did close a deal to license CondraMedic and a distribution partnership with our partner Insung Medical in South Korea. That process has already started in terms of preparing for the regulatory and the reimbursement submission, going along quite nicely. So a good highlight for CondraMedic of the year. The team has strengthened quite a bit since the last fiscal year. Joining us today is Hilary Spence, our new CFO. She'll be talking through a couple of interesting customer metrics that will bring better visibility throughout the year, as well as a new chief business officer, a person named Lou Ruggiero, about 30 years of experience, pure sales and marketing and business development, just joined the team with me in Minneapolis. And then earlier in the year, we announced the appointment of Chris Wattengell as our head of R&D. That's also based with me in Minneapolis. We've gone through a tremendous transformation in terms of what we do in development, advancing our proprietary products, and a lot of projects for customers that he's helped advance, along with our Chief Operating Officer, Tom Hyland, who's been with us for several years up in Glasgow. So a good strengthening of team on the executive side. On the non-exec side, we were fortunate to have Chris Brinsmead join us in January. As a non-executive director, Chris is very well connected with UK Health Ministries and understanding that industry political dynamic, as well as the former president of AstraZeneca UK. So very good pharmaceutical experience as well as commercial execution experience to join our board. A couple of instances of restructuring, just becoming more efficient within the organization. We did announce that we are refocusing our New Zealand operations on the tissue opportunity, which we see good potential for growth, and defocusing on collagen production, which is quite frankly rather duplicative to what we do in Glasgow. So we're under capacity in both plants. It made a lot of sense to merge the two, and we expect 250,000 pounds of EBITDA operational savings, another 50,000 in depreciation that will drop to the bottom line. We also completed our U.S. consolidation. We had R&D separate in California to Minneapolis, where the rest of the U.S. organization was. We put those groups together in Minneapolis, successfully completed that during last fiscal year, and that's been tremendously successful, partly because of the operational savings, but more importantly is the collaboration of the R&D, the commercial teams, and myself being there. Very good analog to how we operate in Glasgow, where we have a strong technical team as well as the operational team there. So two very good and well-established sites now, I believe, with now the New Zealand team being a little bit more lean focused, close to the abattoirs to help with tissue logistics and the tissue business where the source of tissue is. So I think we've done a lot of good work in terms of restructuring the organization there. The theme, as this last bullet point we'll talk about, is how should investors look at the company? How should we be looking at the company? Because the sales cycles are so long, because we have proprietary products that take some time to come to market, how do we know how we're doing? While revenue is an indicator, it's a trailing indicator. It's a trailing indicator of customers that have gone through the pipeline, launched their products, and to some extent, how they are doing in the marketplace. So some of the leading indicators we talk about building value and moving up the value chain is the number of new customers that we're bringing on, how diversified are we, how much under contract, and what does the development pipeline for our own customers look like. It's not something we've talked about too much in the past, but we feel it's pretty important for the investors to understand, and quite frankly for ourselves to understand a lot better now that Hilary has joined and we've been diving into those numbers. And I think as we peel back those layers, we'll see some very positive trends underlying the business that will bode for future revenue. So real quick, a chart on the revenue graph. As you saw on the 6 months in the first half of the year versus the 6 months in the second half of the year, we did see an uptick. We were disappointingly a little short of market expectations. The primary reason for that was one customer that was a tissue customer we'd expected some upside, actually had to pause their project for some time, which we expect to come back, but it was expected at the end of last fiscal year. The other is we signed a fairly significant, for our business, multi-year deal that had some early milestone revenue associated with it. We were fairly certain that it would close before the end of the year. It did not, but the good news is it did close just this last fiscal quarter in the current fiscal year. So with those two issues beside us, those are some of the hits that we had to take, but moving on, we are glad that we closed those contracts, and some of those customers that have paused have indicated that they're coming back, but we did have some timing issues there. So what about the core business? 16 new customers, so that is very significant. Again, up from 9 in the previous fiscal year, and up from 3 in the previous year before that. And that's new customers, not total customers. So that bodes well for the diversification of how we're growing. Also boding well for the diversification was well balanced across North America, EMEA, Europe, Middle East, and Africa, as well as Asia. North America is definitely the biggest market, so it's no surprise that more of our contracts were there, but it was nice to see balanced growth across the regions. Development revenue increased almost threefold, so we'll get into what that means a little bit more in some of the metrics, but essentially it's us getting paid, Collagen Solutions getting paid by customers to help develop a product or a process for them. That is very important because that turns into supply down the road, and that turns into manufacturing down the road. So it's very important for the diversification and the future growth of the business. So we did have some challenges. So underlying that 6% decline is a very significant decline with 4 customers that made up over 800,000 pounds of revenue. Divide by 4, it was roughly 200,000 pounds apiece. Most of these issues happened in the first half of the year, not the second, so it's not necessarily a very new event. The new event that we did talk about is one of our tissue customers that have had to delay part of their product launch plans into most likely next fiscal year. Rather than an uptick that we were expecting and increasing capacity for, there was a bit of a downside. So we did have to overcome that. The other challenge that we've had is in terms of our customer in South Korea that we've mentioned before. Their supply contract ended. They have to work down some inventory, so don't expect revenue from them next year, and it was the biggest customer in the meantime. The good news is we have mitigated it, the revenue side with that contract I mentioned before that we closed in the beginning of this fiscal year, as well as we've mitigated the bottom line in that the New Zealand restructuring that we talked about, all of that customer's business was through the New Zealand plant. So the pause in the ordering pattern actually gave us an opportunity to take some cost out, restructure, move to New Zealand without impacting any of our existing customers, and we've communicated with every single one of them, and they very much understand the plan. We're building the appropriate inventory to make up any buffer for any challenges we may have in the integration, but so far the integration is going right on track, and any financial impact in terms of restructuring has already been taken because we announced this in the prior fiscal year. So that's all been washed through the financial statements, if you will. So really focused now on improvement in sales execution. I feel The same as before about the quality of our pipeline. I think that's indicated by some of the deals that we have closed and the acceleration of the 16. But we can do better, we can do faster, we can look at what are the challenges for getting deals closed faster and also in a better structure under contract as opposed to more of a purchase order basis. So our new Chief Business Officer is taking the lead on that effort, and he joined us in April, but already has been making a tremendous difference. And he had been consulting for us for a little bit of time beforehand, so he came in kind of with eyes wide open of where are the opportunities and believes there's significant opportunities not only for the company, but to help with the sales process. And then finally, we come out of fiscal 2018 with a much more diversified customer base. The best way that we can mitigate in the future, in addition to just to growing sales, is to diversify our customer base such that if we have 1 or 2 customers, or 4 in the case of last year, that have some sort of decline in ordering pattern or a delay in their project, it doesn't have quite an impact on a smaller customer base. So that's been a big goal of ours, and it actually has happened throughout the years. We have diversified that customer base. So going into fiscal 18, we're a little bit more spread out. Just diving into the revenue details a little bit more, this is a bridge that Hilary's team has put together. Kind of gives you an idea of the impact of that roughly 800,000 pounds, offset about half of that, roughly 400,000 pounds of new business that we did grow in the meantime, but that's how we got to this year's revenue number. The more interesting thing is if you look at the series of pie charts on the other side of the chart. So we are showing fiscal 17, where that thin blue slice is a small segment of development revenue. So that means most of what we were doing was supplying either tissue or collagen in more or less a raw state with some customization. In fiscal 2018, which we are just reporting out on, again, that over threefold increase in our development revenue. So what that means is 1 to 2 years down the road, as those development products finish and get onto the market, that bodes to the health of the future of the business. And what's very interesting is that we're doing our internal projections and forecasting for this fiscal year, 2019, nearly half of our business is going to be development revenue. So we're seeing, and this is not what we expect or project in terms of closing new customers. These are actual contracts we have in place, development work that we were doing. So this is if we execute on our timelines on time and our milestones come through. Roughly half of our revenue will be through that development, which again, if you think about the next 2-3 years after that, that's all new revenue coming through. So a very high-level way of looking at it, maybe this next chart explains it, is 3 years ago, roughly, we were talking about the strategy of Collagen Solutions is to move up the value chain. That means moving from purely a supplier of raw materials up through more development, more contract manufacturing, and ultimately to finished products and finished medical devices. So what we've done in that case is you can see we've onboarded 11 new contracts in terms of development. So from our customer perspective, instead of supplying just raw material, we're moving up the value chain and doing development work and doing OEM work. And then as far as ourselves in terms of proprietary products, we've got our chondromimetic cartilage product that is nearing CE mark, and we should have the first patients actually in this fiscal year, along with the CE mark in this year. As well as we have 2 other proprietary products about to go into animal work. So we'll generate the data to be able to have those partnership discussions on the bone and the wound side as well of our products. So on an overall snapshot of what does it mean to move up the value chain, this is what it is. Whether it's our own products or whether it's developing and manufacturing products for other customers, it's moving from a raw material supplier purely to a more full service developer and manufacturer of products. Another way of looking at this, and we can go more deeply, this will be in our annual report, is to think about our business, our core business, from a customer perspective. Every customer goes through roughly these 4 stages. They start with an evaluation, working with us on a very discrete level where we'll provide some materials, we'll do a little work with them. We typically don't generate a lot of revenue from that stage, but it gives them enough confidence that we can solve the customer's problem. Then we go into a development phase. Now, either our customer does their own development with our raw materials and we get revenue from that perspective, and we support our customers in terms of technical support, formulation, et cetera, or the customer will outsource that development work to us, in which we get significantly more revenue, and then we will help use our expertise, leverage our internal know-how to develop a product for the customer. Then we'll go into a phase that is the regulatory process, where the project is done and we're waiting for either the FDA or the notified body, in the case of the CE mark, to give us a clearance or approval to the product. Typically, unless they're ramping up inventory in anticipation for a launch, we won't see much revenue there because there's a bit of a waiting period, and then they go into full launch. So this is a pattern that we do understand now about the business. What we understand a lot more now is every single one of our customers, where they are within their product launch life cycle, how we participate in that. And that's basically getting a lot closer to the customer and understanding where they are in the process. So that's been tremendously helpful for us understanding the ups and downs of the business, because there will be some ups and downs, especially as they move into regulatory, but at least now we can anticipate that a little bit more clearly. The other thing that's important is as we move closer to the end product, whether it be contract manufacturing customization or a full product, we're much closer to the end user customer, and therefore much closer to the variations of supply chain there, as opposed to far on the other end on raw materials, where changes in demand are greatly amplified, and that's why we got some of these blips that we may have seen last year. So not only does moving closer to the end value of the supply chain help us with revenue and margins, but it also helps us more with predictability. So just to summarize the core business, we talked about the 16 new customers. 14 of them are actually under contract, and that's a metric that we're looking at, is how many contracted new customers do we have. Again, up from 9 from last year. One of the bright spots is Europe growing 40%. So why did Europe grow 40% as opposed to not having growth in North America and Asia Pacific? Is the 4 issues that I mentioned earlier, in terms that none of them had touched Europe. Also boding well for Europe is we just recently hired a new sales manager. We did much of that growth without the benefit of a sales manager for about 6 months out of the year. It was a lot of the networking of the internal team. And so that individual just started last month, and that's very positive. And again, I did mention the 271% growth in our development contracts. ConjureMedic, obviously that was a very big milestone of signing that deal and having the 8-year data. And starting with the CE mark. Our intent, again, is to have the CE mark this year so that we can have the first-in-man patients by the end of the fiscal year, and that remains our goal. So far, everything seems to be on track and positive. We talked about the board and the executive team, some of the ads that we had there. China, so that's another highlight. During the fiscal year, we ended our joint venture that we had in China. The joint venture did get us to a point where we got import permits when we got the establishment in China, which was very good. One of the challenges we had in the joint venture was, while it is a slightly different way of doing business in China, and you do have to have the local expertise, what doesn't change is the science and the technology and the processes. And that's where we add, frankly, most of our value, is our own internal expertise, our own partnering and working with customers, just as we did in South Korea. It's equally as important in China, yet the market is significantly bigger. So in order to have that direct connection with the marketplace and with customers, we just had to be a lot closer to those end users and those customers, to be able to provide the support and to be able to work with channel partners who equally have an expertise in this domain space. A very amicable dissolution of the joint venture. We got 100% back of the equity, which we're very appreciative of our former partners. And with that, we're now able to talk directly to some of the channel partners, kind of one step lower in the supply chain organization, or the commercial organization within distribution within China. We've already had quite a few conversations. We've been to China 3 times. I just got back 2 weeks ago, and we're fairly confident we'll be able to sign on, say, 2 to 3 distribution and channel partners within China with very specific targets and opportunities of where we can sell our products within to China. So feel very good about that. Talked about finishing our consolidation in the US into Minneapolis. We talked about initiating the restructuring in New Zealand, which will be happening throughout this year. And overall, we feel we have more of the right people in the right places globally. So that's key on operations. ConjureMedic, as a reminder, that is our cartilage product that was originated many, many years ago as a joint venture between Cambridge University and MIT in the United States. It was originally subject of a clinical study back in 2009. We were able to pick up the assets after a series of of transactions and reported out fabulous 8-year data, not only from a clinical functional score, but also from a MRI scoring in terms of the quality and the quantity of the cartilage regrown. So that data has been very well received with everyone we've been showing it to and having discussions with. And we are in fairly late stage discussions with a number of distributors throughout Europe to support our launch, our first in man use, so I should say, by the end of this fiscal year, and our full launch of the product next year. The other 2 proprietary products on the bone graft and the wound side, a little bit earlier in the process, but our main goal is to complete the preclinical animal work. With that data, we'll be able to have more fruitful conversations with potential partners to see the data on those 2 products. I did mention some of the additions to the executive team and the board for your reference. Their brief bio is there, more information is on our website. So finally, before I ask Hilary to say a few words about customer metrics, I want to talk about what are we going to do this year. So what are our goals? These are the same goals that we have for the internal organization, the executive team, all the way down. The entire organization's aligned around this. First and foremost is to set realistic financial goals and achieve them. And we'll be the first ones to raise our head and admit that we've been very ambitious in our goals, in the public goals as well, and I think that's been a bit of a challenge for us. I will say this right out of the gate, that nothing has changed my mind as the opportunity that we have before us. In fact, if anything, it's been strengthened given the quality of the ContraMedic data, the response of the distributors to ContraMedic, and the significant improvement in the mix of customers and the development work we have in the core business. Having said that, we do want to set some realistic goals that we can achieve, and achieve a profitable run rate by the end of the year. So those are our financial goals, which are key. Within product development, as I said, it's to complete the process, the CE mark, achieve first in man by the end of the fiscal year, as well as set up the appropriate distribution. And then I talked about the animal studies for the other products that are going to be critical. Commercial, again, a new chief business officer, a new sales leader in Europe. We continue to invest in the sales organization and to have them productive. We do want to be productive and grow in every territory. So North America, Asia Pacific, and Europe, our goal is to grow there. Our goal as well is to find the appropriate distribution for our proprietary products, as well as the appropriate distribution in China. So those are 2 goals that we have set for ourselves on that side. And then finally, part of restructuring New Zealand is not just about cost savings, but it's also importantly about focus and diversifying and growing our tissue business. On the one hand, we had a good tissue business, very focused in cardiovascular heart valves, very focused with a handful of customers. I think what we've seen last year is that focus and that concentration could be a benefit when it goes up, but it can be a risk if some of those customers go down. So given this lull with one of the customers, we've taken that opportunity, as well as the additional capacity that we built last year. We're diversifying our customer base, not only within cardiovascular, but within other markets and also with other tissues. So whether it be carotid arteries, whether it be nerves, whether it be bone, and also other species. So we have started now to source and supply porcine pig tissue in addition to bovine or cow tissue. So that diversification is important, and the entire New Zealand team is focused on that effort. And then lastly, on the investor relations side, the main area of improvement we'd like to see, we are going to do in investor relations, and basically starting today with some of these discussions that we're having, is to provide investors a clear window into what is happening with our core business. And what I mean by that is we've talked a lot about proprietary products. We've talked about the opportunity ahead with proprietary products. And we've talked about generally investing in the commercial side and growing our core business. But frankly, revenue is a trailing indicator, and in some cases it's a 2-year trailing indicator of the health of the business. So we put our heads together, Hilary's taken the lead on this, and with the help of some of our analysts, is what can we provide our investor base and potential investor base to give an idea of the health of the future of the company with respect to these early customers that we're onboarding, and where are we in the development cycle and so forth. So that's a goal of this year's. It'll be in our annual report. We're talking about some of these numbers here today, and it's in our presentation. And with that, I'd like to turn it over to Hilary to talk about some of these customer metrics.
But I just wanted to share some of the metrics that we're starting to develop to try and help outsiders to understand what's actually going on within the business. So we've got a number of metrics up here. A couple of them Jamal has already mentioned. So we've talked about new customer wins. I've actually, because I'm a financial person, separated it out and actually looked at a number that's customer agreements, because if I've got a filing cabinet in the corner of my office that's got a signed customer agreement, that feels to me to be quite a certain piece of paper. So we've got customer wins of 16, 14 customer agreements. Both of those numbers are up significantly on the prior year. And there's two at the bottom that I want to spend a little bit of time on. That number at the bottom left-hand corner, future business. So we've got 22 customers in place that are at that pre-supply phase. So they're either in, they're going through the regulatory or development process with us, and we're working with the customers there. Now, if you imagine that the supply revenue coming from those customers is coming down the line, somewhere down the line, that part of our business is growing in terms of customer numbers, but we won't start to see the revenue coming out of that in any sort of scale for a couple of years' time. But given that that part is growing so substantially, as Jamal has talked about, that is a really, really good leading indicator of where the business is headed. The little 73% statistic in the middle of the bottom row is a little bit of an odd one to put up there, because hey, it looks like it hasn't changed year on year. It's 73% for the past financial year and 73% in the prior year. One of the things that has been highlighted is that we, at the moment, are sideswiped a little bit when customers have an issue and our business is impacted. One of the key things that we need to do for the coming year is bring on more customers and get ourselves to a position where our customer concentration is much less in those top 10 customers. So that customer concentration metric for the top 10 customers, currently 73% of our business. Next year, it's going to be much, much, much less. And that will get us firmly on track to being in the situation where if customers are delayed or as a stocking issue or whatever, it has far less of a significant impact on our revenue results for the year. And one little statistic that we're actually really rather proud of is the number of customers that we actually lose. They may go away temporarily, but they come back. So we've only lost one customer in the last financial year, and the prior year was 0.
I think I'd just like to close a bit of a challenging year with a couple of customer issues that we had to mitigate and we had to deal with, and I do appreciate the board's support and the executive teams rallying around having to mitigate those. A couple of lesson learned is to really understand our customers better, which we've done a good job of, as well as understanding this product cycle and what we can do. Very proud of the fact of the number of new customers that we brought on, the diversification. I think it bodes well for the future of what we can deliver. And then, the one thing that you can't buy ever is time. Very hard to do that. So having 8-year results of the chondromimetic cartilage implant showing those very positive results. Again, there's nothing comparable out there that will be in the market that has that kind of longevity. So very positive that we achieved those milestones. Having said that, the management team and the board all have our heads down about executing on the year. If you want to know what to expect, it's those 5 sets of goals that we laid out, and that's essentially what our news flow will cover throughout the fiscal year. So with that, thanks for your attention, and thank you. Thank you, Hilary.